Hello, everybody. Thank you for joining us for today's public webinar. As you may have seen in our email that we sent out advertising this webinar, we do have a new live market profile primer course that we will be doing. This one will run from April 10th through the 18th. And of course, we'll get to talking about that in a little bit. Hello, Jim.
Hello. So first of all, I talked just a little bit about the primer and the change that is going to be made to the primer and the changes that is being made to all of our courses. I'm in the process of writing a new book. Don't get excited. It's a year away. By the time you get it done and published and everything. But the real difference is we're always trying to find better ways to present information and to relate to you and to the markets. What the difference is, we're now stressing two types of information. Explicit information is information that, the poor highs, poor lows, things that you can see, the value area, high, low, etc., things that you can actually see. Implicit information is information that becomes through experience, and it becomes part of your subconscious in there. The example that we use is hitting a baseball. You can have all kind of people standing sitting in the stands knowing a lot about baseball. They couldn't hit the ball if their life depended on it. But you get down to hit the ball, and you've got, as you start to learn that, you've got explicit information. You have coaches teaching about stances, how to hold the ball, etc. You get scouting reports on the pitchers, the curve, what can they throw the curve, or what kind of pitches can they throw the best. But then as you get experience coming through, that starts to build your implicit information. To be a successful trader, it's going to be a combination of both implicit and explicit information. For example, I talk a lot about tempo. Tempo becomes implicit information. Anyhow, I just wanted to alert you that it's a major change we're making to all of our courses. Okay, where are we right now? We're in an intensive right now. And one of the things that I pointed out last Thursday, as the market made a new all-time high, late in the afternoon, and you saw, if you by any chance looked at our YouTube video over the weekend, you saw it highlighted, and we talked about the KLM period formed a short-term balance. That short-term balance low existed until 2 days ago. And what we said, if there was going to be, any balancing of the inventory, you would find acceptance below that balance area low, which we've had. And since that, the market's been one time framing lower for the past 3 days. Yesterday's low was a tick above the prior all-time high. The prior all-time high is what I label as a go, no-go level. It is a major reference. It is a reference that, any trader can find. So what you saw, it came down yesterday and it bounced off of that by a tick. That's a weak low. But if you think of this coming down to that low, I look at it as like a semi-permeable membrane. Every time you hit it, it gets weaker or touch. So yesterday was one touch. It weakens it a little bit. The odds are huge that you will bounce off of it the first time. I mean, I would guess the odds are probably in the 80% category that you're going to bounce the first time. Traders know it. They can see that, and they just kind of automatically respond there. Now, overnight, the market went down through there again. I'm going to call that the second touch. So that weakens it even further. Now, overnight inventory, if you follow this, overnight inventory was very short last night. And as we've said so often, the odds are about 75% that you will get a counter auction relative to overnight inventory. If you don't get a counter auction to overnight inventory, that's usually a sign that there's weakness. In this case, if overnight inventory was short and you didn't get a counter auction in it, that would be an indication the market was even weaker than it might have appeared the last couple of days. So right now we've got what would be expected. We got a counter auction, and you've got to be very careful, because a lot of times the counter auction relative to overnight inventory can mislead you, because a short covering is going to take price higher. You see that price going higher, and then that may bring in some more momentum buying. But be careful, because that can be misleading. That can get you into a trap. I don't know if it will or not, but now you look and you say, okay, what's happening to value today? The last 3 days, value's been moving lower. It went down to a very mechanical reference, and we'll keep that reference for the prior all-time high. Below that, of course, would be the top of the gap from last week. That would be your next reference on the downside. So now all you're doing so far is you're getting short-term balance. Incidentally, if you don't know, we measure overnight inventory from the settle. If most of the trade took place below the settle overnight, then overnight inventory is short. Overnight inventory is short. The odds about 75%, you get a short covering rally. Now you want to be very, very careful. You want to be very careful that you don't mistake that for something more powerful. It may be more powerful, but it's a caution in here. Now, the last couple inflationary numbers have kind of surprised the market a little bit. The market got through it, but we've got PCE tomorrow, and which they keep saying is the Fed's favorite gauge. Usually, if longer term money is going to make any adjustments ahead of a major number, it's usually made and completed by 2 days prior to the number. And the reason being that the markets before the day before the number are usually pretty thin, and the liquidity is not there. So usually they've made that adjustment, ahead of time. The other thing that we saw when CPI came out, and it was very tricky, but you saw late in the day prior to CPI, all of a sudden the market broke, and you had no excess on the high, but the market broke. And what I caution about is what I call it the wisdom of crowds. It's not uncommon that people knew or could realize that number might not be good, and so late in the day the market broke. And of course, as you saw the next day, it was really weak. So you want to be careful of that today. So where we are right now, the market, we've one time frame lower for the past 3 days. Volume was lower yesterday, our value was lower yesterday. Today, value is building, overlapping to lower. It's still an inside day. We're still within the overnight range in here. We've had a short covering rally relative to overnight. So you want to be very careful. That can be misleading. Right now, we're forming short-term balance. Forming short-term balance ahead of PCE tomorrow. Okay, Jen, do a short commercial, and then we'll come back and I'll take questions on the market.
Okay, 1 second here. I'll take the screen briefly. Can you see my screen?
Yes.
Okay, so if you're new to us or not as familiar with our website, you can find our courses information by going to jimdaltontrading.com and go to courses at the top navigation. You'll see that the live market profile primer is featured up here at the top. We also have the schedule posted so that the timings of class, and obviously these are posted in Eastern time, so you would need to adjust for your time zone. But I just want to mention that all of the webinars are recorded. If you purchase the live market profile primer to join us, you will have access to your materials for 3 months after class finishes, so that you have time to go back and review. And that's specifically for the primer, since it's such a short course. It's only 8 days. I often get asked, who is the primer for? So I want to just say, to sum it up, folks that are new to market profile, you may be a new trader, maybe not, but if you're new to market profile, it would be great for you. Traders that have exposure or some knowledge of market profile, but want to make sure you understand the concepts as Jim intended. And experienced traders looking for a review and refresher, and want to hear Jim narrate the live markets on the second half of the course. And so, like I said, you can see details here. Something that sets aside our primer, how our primer is different from our foundational e-course, is a couple of things. One, we can't cover everything in our foundational e-course in the live market profile primer. This just gives you a taste and idea of all the variables coming together. The first 4 days are the linear education portion, along with plotting the profile manually. If you are a person who doesn't have market profile software yet, or doesn't want to pay for it, then we recommend you'd want to join us for this, and because we do it as an exercise to plot the profile manually. And even if you have software, that is a worthwhile exercise that we recommend all traders do, so that you truly understand how it's done and you have a better appreciation for value and how it can change. And then the latter 4 days, we provide live commentary when we're not in a live webinar, our daily reports, which is our form of homework, and Jim will narrate the live market, and whatever it throws at us, he will discuss it, even if it's a more advanced concept or whatever. Even if newer folks may not be able to fully appreciate it, he will discuss it, because it's whatever the live market gives us. So if you've got any questions, by all means, shoot us an email at dalton@jimdaltontrading.com, or you can give us a call, and I'd be happy to answer any questions that you may have. Okay, and also, our early bird pricing is $389 right now. That price will be valid through March 10th, Sunday, March 10th. So purchasing early whenever we release a live course will always yield you the best price. Okay. So, okay, Jim, I'll give you back the screen.
Okay, thank you. Before I take
one other thing. I'm sorry, one other thing I wanted to mention. The foundational e-course, you can find information on that on our website too. We are thinking to have a summer intensive this year. So if you weren't able to join us because you didn't have the prerequisite requirement to join us for an intensive, which is the foundation and application of the market profile e-course, you'll want to check that out here and make sure that you complete that so that you can join us when we have our next intensive. Okay, sorry.
Okay, thank you.
I will give you green. There you go.
Okay, so just a real fast review of where we are right now, and then we'll open for questions. So the market's been, as we wrote on the YouTube video over the weekend, I was expecting consolidation of the most recent gains. And we said if we got that consolidation, it would start with acceptance below the late balance that we had last Thursday. Not the excess high on Friday, but the late balance on Thursday. Since that consolidation is taking place as we had anticipated. With the market's been down for 3 days in a row. Today is an inside balancing day as we get ready for PCE tomorrow. The major reference on the downside is the prior all-time high. It's an easy number for people to come up with and to see. As we said yesterday, it bounced off it. The first time it reaches that is probably an 80% probability that you'll bounce. That's the first touch. Went through it last night, kind of a second touch, close to it today. So you're getting more and more acceptance down here. But that is your key downside reference up there. Okay, let's open for questions, please.
Okay. Does one time framing up today so far mean anything to you?
No, it really doesn't. And it's noticeable, but it's been so slow and sluggish. But notice one of the things that kind of negates that. Notice the C period low is exactly at half back from B period. Now, that's only one indication. But what it's telling you is that the buyers came in at an exacting level. When they come in an exacting level like that, that is usually an indication of short covering or short-term buying. So that it's just a nuance. But we do have, remember, overnight, we had a double distribution overnight. When we have what we look at from overnight, we look at the overnight high, we look at the overnight low, we look at a prominent point of control from overnight, and we look at a double distribution. So we treat this as two separate auctions. We don't pay any attention to the good highs or lows from overnight. There's not enough volume. So we are into that second distribution now, and notice that the second distribution, is just about half back from overnight, half back from today. So if there's any weakness develops later today, you would see this distribution closed. If you hold this distribution, then you maintain balance. If there's any weakness that develops later on, you will see this double distribution from today closed. Okay, other questions?
Okay. How could one measure tempo if one does not have Window Trader?
Well, you don't need Window Trader to measure tempo. And tempo is just its pace. And remember, as if you're watching a market, if you got somebody just to watch the market, you can get a feel. You can get a feel for it. As a 30-minute bar is advancing or slowing, or just as the price. It's something that you develop subconsciously over a period of time. But it is, in my opinion, and most people, what happens? I mentioned tempo and the importance of tempo, and then people start looking for tempo everywhere. Tempo is most important when it's clear what the market is trying to do. Tempo acts differently with the trend versus against the trend. Okay, what else?
Okay, are there
I'm sorry. Let me say, there's many other ways to get the profile. It doesn't have to be Window Trader. Okay. I interrupted you, Jen. I'm sorry.
Okay. Are there specific periods during the session that you expect for significant moves? For example, D period frequently seems to make a big move.
No, I think when you get that in your mind, let me back up. Sometimes people get targets in their mind. I think that is very dangerous, because I think it really stops your free flow of accepting information. People like to say, oh, when they close in Europe or lunchtime, the market's going to be different. Real traders, if something's going on in the market, they will be there. I used to be in business with a guy that, I think he had 52 phone numbers he could reach any place in the world. Real traders will be there. So if you start thinking there's going to be one time it's going to be better than another, it can block your thinking and take away some of your objectivity. Clearly, it's more active early in the morning as the market opens. It's usually more active when the market closes. That's just kind of natural things that you see in the market. But I think you want to put that aside, because I think you'll get focused on that, and I think that cuts off the free flow of other information that may be coming into the market. Okay, other questions?
Okay. Jim talks about anchored trades. Can you explain what anchored trades are, please?
Daniel Kahneman and his partner at the time, Amos Tversky, who's no longer with us, we talked about, heuristics. And heuristic is just anything that somebody decides is relevant. For example, you see you go into the to the store and you see a sweater marked at $99.99. Now, if we consciously talk about that and you're laughing, you say, who are they kidding? You know, a penny or two difference. But what that doesn't tell you, it doesn't tell you psychologically what goes on in the mind, even though, you know, if we're talking about it, we laugh at it, but it doesn't tell you psychologically what goes on. Now, when you look here, C period exactly at half back from B period. This is an anchor. This is an anchor. The fact that it's half back from B period, that is just something that somebody has decided. That is a heuristic. There's no real reason other than that people have decided that they're there, just like 99.99. That is an anchor. Now, an anchor trade, and it's only a certain personality can carry off anchor trades. A person that does an anchor trade is somebody that they're very immediate. It either works, it doesn't work. There's no second guessing. They're very hard to do. They look good after the fact. But an anchor trade will always be executed opposite of the current market. So if this market comes down exactly to the half back in B period, and that's an anchor trade, that's your buy. But remember, it's flying in the face of what has just happened in the market, which looks nice afterwards when it went up, but it's a very difficult trade to execute. It either works or it doesn't work in there. Okay, but it's a certain personality. I do not recommend trying to do anchor trades, you know, and other trades. It's a different mindset. Now, there's another thing, even if you don't do anchor trades, the anchor is educational. I use the anchor to tell me who am I competing against. When I see a lot of this going on, it gives me a pretty good idea that my competition is short-term traders. It is unlikely that serious trading money is going to buy exactly at half back from the B period high. So knowing who I'm competing against is very beneficial to determining what I want to do throughout the day. Okay, other questions?
Okay. The fact that you switching to a 2-tick TPO increment, is that indicative of your evolving thoughts on market profile?
No, I've just found that if I put it in 1 tick, I tend to be a little bit more emotional. 2 ticks just makes me a little more comfortable with the volatility. It's just a personal choice.
Right. It used to be that he would switch back and forth after observing, you know, depending on if volatility was high or not. And now he's just kept it in 2 because he's just found that that's more comfortable overall. Okay. Any comments on tempo? It seems better today than the last 2 days.
Well, remember, I think today is probably short covering. And short covering, I mean, so everything has to be looked in, you know, in some perspective. Short covering will usually appear to be pretty quick because, you know, when you're short, oh, get me out. So yes, has this gone up pretty quickly from here? Yes, but I think it's mostly short covering. The fact is, it can't be viewed in isolation. Remember, it's still inside yesterday's range. It's still the inside overnight range. So I'm not making any consideration to tempo right now at all. And remember, introduce tempo, and then people look for tempo every place they add. And there's just sometimes it's just not that relevant. Okay. What else?
Okay. I still struggle with acceptance. Could please Jim explain more how he defines acceptance, and should the market move below the 5,066.50 go, no go level? Is acceptance based upon the number of ticks or TPOs or something else?
No, it's, you know, again, it's a concept like going to an auction. And when you think about this acceptance or rejection, but if you think about it in terms that the market is a continuous two-way auction process. So let's say you and I go to an auction and the auctioneer is trying to get, some piece of art started at $100,000. If nobody will lift the bid at $100,000, he drops it down to say, 99.5. Finally, at 97.5, all of a sudden it attracts the bidders, and the bidders start, and then it kind of catches on, and they start, getting aggressive. So you look down here, the auction finally got started. So in other words, price was accepted here. It was never accepted down here. It got rejected. And there's no number of ticks or anything else. Yesterday, the market got rejected right off of the prior all-time high. Again, acceptance is it's something accepted over time, accepted by volume. There's no magic to it. But when you're looking and say, okay, this is rejected, this is rejected, this is rejected, this was rejected, okay? And acceptance is going to be over time. And again, there is no exact definition to acceptance. It is something that you learn implicitly with experience. Okay, what else?
Okay, there are some more questions here, but I'm just going to mention, based on some of the questions here, I would recommend that you consider joining us for the primer in April, simply because a lot of these things that people are asking would be explained in the primer, and that's our lowest cost live course. Okay, the next question here. I bought your book and I see that you don't use or talk about the initial balance anymore. Can you explain why?
Yeah, what I paid $10,000 to sponsor the book, Pete's first book, and I went to Pete's courses.
Pete Stottlemyre, for folks that are not familiar.
Yeah. And I learned, the things that Pete taught. And then as I wrote my own book and as I looked at these things over the years, I determined it wasn't valid. I mean, it's still valid on some days. So I don't use initial balance per se anymore, but I do use the concept. Initial balance was, it was like, okay, did the market find a little balance? We used to define it by the first two periods. Now I look and say, okay, when I look this morning, okay, there's a little base, and I'll say, okay, the early morning base is pretty narrow, easy to knock over. This, a lot of times, a little base like this early on leads to a double distribution day. Okay, so I don't use initial balance in the way it was described in the book, but I still use the concept. Market opens inside, you get a short-term balance, and then then you get a little break to the upside. That's all I do with it. So the concept is valid. I've never let go of that, but just the exactness of the way it was defined early on has changed in my mind. Okay.
Okay. And just to let folks know, people who are familiar with Jim's books, our courses, our e-courses and our live courses reflect changes from the time that his books were written. And so if you haven't followed Jim for very long, or you only recently found us, obviously you wouldn't realize that those changes have occurred, but that is something that if you're reading the book, or if you're on the fence about joining us for, like, say, the primer, might be a good idea to consider it, simply because you'll come to understand, and we do go over a list of the things that he's changed or discarded, and you'll come to understand why, so that it will make it easier to understand when you go back to finish reading the book about certain things, that you don't need to commit that to memory. And it just kind of helps in terms of the learning curve. So you're not committing something to memory that you then have to discard or modify after the fact. And the unlearning can be very difficult for some folks. So I just want to mention that. Okay.
Okay, now before we go to the next question, remember I didn't like the C period low because of its exactness? Guess what? I'm not enamored with the E period high because it's exact to D period. More than likely, short-term buyers, more than likely, short-term sellers. Consistent, we're within yesterday's range, we're within the overnight range, big numbers tomorrow, and it's not uncommon that the market, comes into short-term balance prior to those numbers. But also remember, what I started off by saying, overnight inventory was very short. The odds are about 75% that you're going to get a counter auction to overnight inventory. So counter auction to overnight inventory would be buying. Then I said, be very careful, because the single biggest early trap that hurts traders is they mistake the short covering rally for more serious buying. And then they get long and they get caught. And this looks like typical. I don't know how far down it comes. I mean, I don't like this or this, but this is what typical trap, short term. You get short covering from overnight inventory. People that don't understand that it's short covering, all of a sudden they get all excited and they get long and they get caught and they get the whipsaw. Okay, final two questions, Jim.
Okay. Jim, how relevant is market profile for retests that occur during the pit session? More specifically, retests that occur within 15 to 30 minutes.
I don't accept the retest thing. It's not part of my vocabulary. Okay. I mean, the market profile, all the market profile is, it's a distribution curve. All it does is organize the market's continuous two-way process. The question is it valid or not valid, or that's not even a valid question. It's simply a way to organize the market's data. It doesn't work, it doesn't not work. It's just simply a tool to organize the data. Okay, what else?
Okay, was yesterday a late day spike on the close?
No.
Would spike rules apply today?
No, I don't think it was a spike. I think it was just, I think all you had was short covering yesterday. In late short covering, the market had gotten too short. And like I said, remember, when you come down to a major reference, and the prior all-time high certainly is a major reference. And I said earlier, the odds are probably in the 80% category that you're going to get a bounce the first time. And I think the market got short going down there. You got a short covering rally that took you into the close. Okay. Final question.
Okay. Let me see here. Today's cash high was the half back of yesterday's cash spike. Is that an anchor trade?
Anything can be an anchor trade if you know what the anchor is. I don't define anchor trades. It could be half back on something. It could be a Fibonacci number. It could be anything that you think is a reference. Okay. Final question. I said final, but we'll take one more.
Okay. Is the prior all-time high of 5,066.50 the breakout from last week? But we've had two other days that went higher, February 22nd and February 23rd. What makes you keep the reference named as a prior all-time high, and since it was already taken out? Those were taken out.
Well, that was the prior high. Well, look, because everybody knows that number. And guess what? That's what I've been using for some time. Look at yesterday's low. The references I use, they're things that I think the market's going to recognize. And look exactly, yesterday's low was right there. So, I mean, that speaks to the validity of it. There's no magic to it. There's no magic. There's no math. It's just what part of trading is understanding what people do, understanding what to expect of your competition, understanding who you're competing against. As I said, I played racquetball for years. So much of the game, you could beat people that were technically better than you if you knew better than what they were going to do, what to expect of them of certain shots. And that makes a whole difference. What can you expect from your competition? And if you can, what you expect ahead of time can give you an advantage. When I look at this, From what I watch competition, I'm saying they're going to make this, it's an easy identifiable number. They're going to use this in a reference, and guess what? That's exactly what they did. All right, let me say thank you very much. I hope you consider joining us for some of our educational courses. Have a great day and good luck on, well, before we leave, remember I said I didn't like the C period low, and then I said I don't like the E period high. Again, I'm always focusing on this information. They're just little pieces of information. And, it's not one over the other. You're just looking at the total picture of what's going on. But this told me if the selling was weak, this told me that, probably short covering. So you can see the market did come back up there. All right. Thank you very
Okay,
much.
I was just going to end the session by a comment that somebody here made. I've attended Jim's public webinars from time to time in the past, and I found some of the concepts confusing. After I attended the primer, my eyes were opened and I finally understood. It made a huge difference in my trading, and I've continued with Jim's programs. Thank you for that comment. So if you've got any questions, please contact us at dalton@jimdeltontrading.com, or you can call us at the number at the bottom of our website, and I'd be happy to speak with you. Okay? Thank you so
Thanks.
much.
Bye.
See you next time. Bye-bye.